from the very beginning. The financial world told you a comforting story, a story that private credit was safe, sophisticated, and immune to the kinds of risks that shook global banks in 2008. Private credit was marketed as the grown-up version of lending, hidden behind closed doors, run by elite institutions, and insulated from the chaos of public markets. But what if that story was never true? What if the real danger wasn't in the banks we watched, but in the shadows we ignored? And what if the institution now facing the greatest pressure from this unraveling is not a small lender, but the financial giant that promised stability to the entire world? BlackRock. Today, something is breaking beneath the surface, and the cracks are widening faster than most analysts expected. This investigation begins with a mystery. Why would BlackRock, the world's largest asset manager, a firm famous for its calm, measured language, suddenly warn that the private credit bubble is not only real, but beginning to burst? Why change their tone from cautious optimism to outright alarm? And more importantly, what are they seeing internally that no one else is willing to say out loud? We have to go backwards, not months, not years, but decades, to trace how a quiet, obscure lending market grew into a multi-trillion-dollar system now threatening to trigger the next financial crisis. Private credit began as a niche backdoor lending channel used by wealthy investors, hedge funds, and private equity firms to finance companies that banks wouldn't touch. These were businesses considered too risky, too unstable, or too young for traditional loans. But after the 2008 financial crisis, the world changed. Regulators cracked down on banks, forcing them to cut exposure, reduce leverage, and shrink their risk. Blackstone, KKR, Apollo, and later BlackRock realized that they could build an entire empire by becoming the new lenders of last resort. They could charge higher interest, hide losses longer, and operate away from public scrutiny, data reporting, or regulatory transparency. What started small quickly exploded. Private credit grew from $300 billion in 2010 to over $2.1 trillion by 2024. And that number doesn't even include leverage or shadow exposures. Companies that wouldn't qualify for a single dollar in a traditional bank loan suddenly had access to tens or even hundreds of millions. But the problem wasn't just growth. It was the illusion that this growth was safe. Because private credit deals rarely appear on public markets, very few people know what the borrowers look like, whether they're profitable, or whether they can even survive a slowdown. And yet the loans kept coming, the debt kept piling up, and the interest rates kept rising. BlackRock was not the largest player in private credit, but it was one of the most trusted institutions. Pension funds and sovereign wealth funds poured billions into BlackRock's credit strategies, believing that if anyone could manage the risks responsibly, it would be them. But in 2023 and 2024, something changed. Analysts inside BlackRock started noticing troubling patterns, companies borrowing again just to pay interest, loan covenants quietly relaxing, valuations staying flat even as revenue collapsed, and lenders extending terms as a way to hide upcoming defaults. These warning signs were ignored in other firms, but BlackRock, perhaps due to its scale and visibility, chose to speak. The origins of the crisis lie in the simple but dangerous logic that fueled the rise of private credit. The pursuit of yield, low interest rates after 2008 pushed investors into riskier assets. When safe bonds offered 1%, private credit funds offered 8% or death percent. When banks rejected companies, private funds welcomed them. When regulators demanded transparency, private lenders offered confidentiality. And in private credit, most of that risk wasn't measured, reported, or even understood. Companies that should have restructured instead refinanced. Firms that should have downsized expanded instead. Zombie businesses technically alive but financially dead multiplied. The breaking point began quietly in late 2023 when interest rates stayed higher for longer than expected. Suddenly, companies that relied on cheap borrowing faced interest payments that consumed their cash flow. In private credit, many loans have floating rates, meaning when interest rates rise, so do repayment obligations. Companies that could barely pay 6% now face 12%, 14%, or even higher. This triggered the first wave of distress. Businesses missing payments, restructuring quietly, or begging lenders for extensions. Funds didn't mark down assets, didn't disclose losses, and didn't warn investors. They delayed the inevitable. Their models showed that a significant portion of private borrowers were operating with unstable revenue, shrinking margins, and ballooning interest costs. They saw that default risks were rising even faster than during the 2008 crisis. They saw that loan terms were increasingly manipulated to avoid recognition of losses. And they saw that large private equity-owned companies saddled with leveraged buyout debt were becoming increasingly fragile. When they sounded the alarm, they weren't predicting a future crisis. They were describing a crisis already unfolding behind closed doors. The fallout began in early 2024, with several mid-sized companies failing to refinance. Private lenders responded by restructuring debt, offering payment holidays, or converting loans into equity. They delayed defaults but didn't solve the underlying problem. Too much debt attached to too little cash flow. If they liquidated bad loans, they'd have to report losses. The lack of liquidity, once seen as a strength, became a critical weakness. BlackRock noticed that many private credit deals had no real exit. Borrowers couldn't refinance in public markets. The M&A market dried up, eliminating buyout exits. Banks wouldn't touch the loans, and IPO markets were frozen. This meant private credit lenders were stuck holding deteriorating loans indefinitely. Meanwhile, investors kept demanding withdrawals, redemptions, or income distributions. But when assets can't be sold, how do you raise cash? Others used incoming investor money to pay out existing investors, a structure uncomfortably close to a pyramid model. BlackRock's warning was not just about the bubble. It was about the fragility of the entire system supporting that bubble. The failed fixes became part of the problem. Extending maturities delayed defaults but increased total debt. Interest-only structures reduced payments temporarily but ballooned obligations later. Covenant-lite loans removed protections that could prevent total losses. And cross-collateralization linked multiple companies together, meaning the failure of one borrower could drag others down. These hidden linkages created a chain reaction risk, one that BlackRock explicitly pointed to in their internal analysis. And because private credit is interconnected with banks, insurance firms, hedge funds, and pension funds, the damage could spread far beyond the private markets. The patterns resembled the subprime mortgage bubble, opaque structures, delayed recognition of losses, artificially inflated valuations, and lenders rolling over bad debt to avoid defaults. The patterns resembled the 1998 LETCME, collapse concentrated risks, excessive leverage, and hidden exposures. And the patterns resembled the 2001 dot-com crash, optimistic valuations disconnected from reality. Yet the most striking parallel was with 2008, a crisis born not from what people could see, but from what they couldn't. Private credit, like mortgage-backed securities, thrived in opacity. And just like in 2008, the collapse would be silent until it wasn't. Shocking data reinforces the danger. Analysts estimate that 30% to 40% of private credit borrowers could face stress if rates remain elevated. Nearly $300 billion in loans may need refinancing within 2 years. More than $1 trillion in private equity-owned companies depend on private credit lending pipelines. And the average interest coverage ratio, the amount of profit available to pay interest, has fallen below 1.0 for a growing share of borrowers. When BlackRock looked at this data, they realized the bubble wasn't in the future. It was already bursting. Companies default, lenders restructure, valuations fall, funds quietly gate, withdrawals, investors panic, liquidity dries up, and lenders tightened new credit standards. That tightening reduces financing for other companies, leading to more distress. And now, even banks are feeling the pressure, because although private credit operates in the shadows, it is funded by traditional institutions, and losses ultimately find their way back into the regulated financial system. BlackRock's position is uniquely precarious. They are large enough to feel the pressure, but transparent enough that they cannot hide it. They must warn investors, even if others stay silent. And their reputation is tied not just to performance, but to credibility. When BlackRock says pressure is rising, institutions listen. When they say losses are coming, markets pay attention. And when they say the bubble is bursting, it's not speculation. It's a reflection of real-time stress. As we move toward the conclusion, the story becomes clear. The private credit bubble didn't grow by accident. It grew through a series of structural incentives that rewarded short-term gains and ignored long-term risks. It grew through opacity, marketing, and optimism. It grew because investors wanted yield, lenders wanted expansion, and companies wanted easy money. The losses will surface, the defaults will rise, and the pressure on institutions like BlackRock will intensify. The question is not whether the bubble is bursting. It is how much damage it will cause before it stabilizes. In the final moments of this documentary, there are 3 takeaways that every investor needs to understand. First, private credit is not safer than public credit. It is merely less visible. Risk does not disappear when hidden. It grows. Second, the financial system is more interconnected than ever before. A collapse in private credit will not stay contained. It will ripple through banks, institutional portfolios, and even consumer markets. Third, warnings from firms like BlackRock are not marketing tools. When the world's largest asset manager says a bubble is bursting, it means the damage is substantial enough that silence is no longer an option. The warning is real, and the future is uncertain. Only time will reveal the full extent. But one thing is clear: the era of easy money has ended, and the consequences are unfolding now. If you found this investigation valuable, subscribe to the channel for deeper breakdowns of unfolding financial risks and the hidden forces shaping the global economy. Stay prepared, stay informed, and never rely on the narratives that comfort you. Rely on the truths that protect you.